What are the 10 most important questions to consider before making an investment in a company? Hi, my name is Gary Mishurs. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So, what are these 10 questions you should consider before you make any investment? Well, the first one should be, do you understand the business? And by understand, I mean, do you know how they make money? Do you understand what the product is, why it's valuable to the company, to the customers, and so forth? Now, that's pretty important. If you don't understand the business, if they're doing something so complicated you can't figure out either how they make money, what value they actually add to their customers, you should pass. Number two is, can you look out 5 to 10 years into the future and approximately predict the important economic characteristics of the business? So sometimes you might understand what the business does, but you have no idea what the future looks like, or the range is so wide as to be pretty much useless. So that's another good reason to pass. That's actually something Warren Buffett does quite a bit. Is if he can't figure out how the business is likely to change going forward, or what the future economics might be, he's just going to pass. And that makes a lot of sense. If you don't know what the business's future is, how can you value the business, and how can you figure out if it's a good investment at the current price, right? So the next question, number three, is, can the balance sheet withstand temporary adversity? So can there be a severe recession or a company-specific problem, and can the business still do okay and survive without either going bankrupt or massively diluting your intrinsic value per share by issuing, say, equity or equity-like instruments at a very disadvantageous price? And you want to do some scenario analysis and understand, is that something that is, a real danger here? So that's number three. Number four is the management honest? I think that if the management is trying to make money off of you and is trying to deceive you, then that's a problem. It's going to be harder to have a good, successful outcome in an investment. And there's a few ways, to think about it. One is you can see how they pay themselves in the proxy statement, and you also can read their communication. And usually, honest business people talk about both the good and the bad. They will say, here's what's going well, and then also, hey, these things aren't going so well, and here's what we're doing about them. That's kind of what you want to hear. Versus if you have these very promotional people who, there's never a problem in the business. Well, guess what? There will be a problem, or there might be a problem. You just won't know about it until it's too late. So that's number four. Number five is the management competent? They might be honest, but you want to make sure that they also can do what they're trying to do. And in this case, you want to understand, are they competent at running the business, and are they at least moderately competent at allocating capital? So you want to make sure that these people can get the business to where it needs to go and have it overcome challenges that it's likely to encounter. Number six is, what fundamental developments would be responsible if this business were to fail? So that's kind of like the idea of a pre-mortem. It's kind of, you're traveling into the future and you're doing a post-mortem on a failed investment. So what would have had to happen? And this will help you flush out what the key risks and the key real drivers of the business are. So number seven is, what evidence over time would confirm my thesis? So investments aren't made, and you don't. It's not like you buy it and you forget it. You have to track your thesis. You have certain idea of what this business is likely to produce as far as long-term results, and you want to have some system where you're tracking its progress and deciding, is it now more or less likely that I was right at the beginning. So you want to lay out some key metrics, some that you expect to happen over time. And it's not to say it's important to have quarterly earnings mapped out. That's silly. Like, people do it in investment business. I have no idea why, because who cares? But if there are key operational metrics that you're tracking, or just other important signs that your investment thesis is in the right track, you want to understand what those are, and you want to understand when the business is actually meeting those objectives. Number eight, and I would argue this is even more important, is, what evidence would you have to see that would be disconfirming to your thesis? So what would you need to see to start thinking, maybe I'm wrong? And because it's hard to tell, sometimes businesses have temporary problems for short-term reasons. They're not indicative of long-term problems. So you want to kind of lay out in advance, what are some things that, if you see them, you say, you know what, I think that's evidence that I need to reassess whether I'm right on this business or not. Number nine is, does the valuation of the security afford a very big margin of safety versus the reasonable range of intrinsic values for this company? And that's very important because you can have the best business in the world run by the best people with a good balance sheet, but if it's at the wrong price, it's going to be, not a good investment. And there are some people who I know will disagree with this, but just do yourself a favor. Like, check this mental exercise out. Pick your favorite company and see, would it be a good investment if you paid $1 billion a share for it? Probably not. Now you might say that's ridiculous. Well, but that's the whole point. Is there's some price at which an investment is good, and there's some price at which it's probably less good, and it's a continuum. It's not like there's black and white. But you do want to understand that you want a margin of safety in the form of a gap between price and value. And finally, you want to think about number 10, which is, what are the opportunity costs of my investment? So if you commit capital here to this investment, what other investments are you not going to make because of that? And the key here is not just the current opportunity set, because that's probably too low a bar, but also the likely future opportunity set. So let's say you make this long-term commitment to invest in the company, and then right now this might be your best investment, but it's not particularly attractive on an absolute basis. And then in 18 months, another great investment comes along, and you're committed to this investment. Now, you may say, well, I'll just sell and I'll switch investments. Maybe, but what if this investment that you are thinking about making right now is temporarily depressed in price and you can't switch without a big loss? Well, so that's something you think about. And that will give you a perspective on whether this is a good investment. Hopefully these 10 questions have been helpful to you. If you like this video, please hit like and subscribe to my YouTube channel for more investing videos. Thank you, guys.